What's up everybody, it's Gupta Santa, and let's talk about building long-term wealth. You know I like to keep things real simple, and that's why today, we're diving into one of the most effective hands-off ways to invest and grow your money index funds. An index fund is a type of mutual fund or ETF that tracks a specific market index like the S&P 500 or the Nasdaq 100. Instead of trying to pick individual stocks, you're investing in an entire market segment, giving you instant diversification. Think of it like buying a small piece of 500 different companies at once. The best part? Index funds are passive investments, meaning they require less management and come with low fees compared to actively managed funds. Alright, let's break down some of the most popular index funds, starting with the S&P 500 Index Fund. Essentially, when you invest in an S&P 500 index fund, you're buying a tiny piece of the 500 largest publicly traded companies in the United States. Think about it, Apple, Microsoft, Amazon, Google, all the big players are in there. It's like owning a slice of the entire US economy. Historically, the S&P 500 has returned an average of around 10% per year. That doesn't mean you'll get a guaranteed 10% every single year, but over the long haul, that's some serious growth potential. Now, I know what you might be thinking, but Gupta, isn't it risky to put all my eggs in one basket, even if it's a basket of 500 companies? And you know what? You're right to think about risk. But here's the thing, because the S&P 500 is so diversified across different sectors like technology, healthcare, finance, and more, it's actually less risky than trying to pick individual stocks. If one company in the S&P 500 has a bad year, it's not going to tank your entire investment. The other 499 companies can help balance things out. That's the beauty of diversification. Of course, past performance isn't a guarantee of future returns, but the S&P 500 has a pretty solid track record. So, if you're just starting out with investing and you want a simple, hands-off way to get exposure to the US stock market, the S&P 500 Index Fund is a fantastic option. It's like the trusty Toyota Camry of the investing world, reliable, efficient, and gets the job done. Now, if you're feeling a little more adventurous and want to potentially juice your returns, there are other index funds out there that might be a better fit. But for a solid foundation and long-term growth, the S&P 500 is a great place to start. Alright, so you're ready to level up your investing game, huh? Well, buckle up because we're about to dive into the Nasdaq 100 Index Fund, the sports car of the index fund world. If the S&P 500 is like the reliable Toyota Camry, the Nasdaq 100 is like a sleek Tesla Model S. It's got the potential for some serious speed and excitement. This index tracks the 100 largest non-financial companies listed on the Nasdaq stock market, and, let me tell you, it's heavily weighted towards technology. We're talking about companies like Apple, Microsoft, Amazon, Google, Facebook, all the heavy hitters in the tech space. So, if you're bullish on the future of technology and believe these companies are going to continue to innovate and dominate their industries, then the Nasdaq 100 could be a great option for you. Historically, it has delivered higher returns than the S&P 500, but remember, with higher potential returns comes higher volatility. Think of it like this. The Nasdaq 100 is like a speedboat. It can zip across the water and get you to your destination faster, but it's also going to be a bumpier ride. The S&P 500, on the other hand, is like a cruise ship. It's going to take a little longer to get there, but it's going to be a smoother journey. The Nasdaq 100 isn't for the faint of heart. It's more volatile than the S&P 500, meaning it can experience larger swings in value both up and down. But for investors with a higher risk tolerance and a long-term time horizon, it can be a powerful engine for growth. Just remember, diversification is key. Even though the Nasdaq 100 is already somewhat diversified within the technology sector, it's still a good idea to have some exposure to other asset classes like bonds or real estate to balance out your portfolio. Chapter 3. Total Stock Market Index Fund. Owning the entire US stock market. Alright, let's say you want the simplicity of an S&P 500 index fund, but you also want even broader diversification. You want to capture the growth potential of not just the 500 largest companies but pretty much every publicly traded company in the US. Well, my friends, that's where the Total Stock Market Index Fund comes in. Think of this as the ultimate set-it-and-forget-it investment. With a Total Stock Market Index Fund, you're essentially buying a tiny piece of the entire US stock market. That's right, you're getting exposure to large-cap companies, mid-cap companies, small-cap companies, and everything in between. It's like having a giant net that scoops up all the fish in the ocean, instead of just focusing on the biggest ones. This broad diversification helps to reduce risk, because if one sector of the market is struggling, other sectors can help to pick up the slack. Now you might be thinking, Gupta, if it includes all these smaller companies, wouldn't that make it riskier than the S&P 500? And you know what? You're not wrong to think that. Smaller companies can be more volatile than larger, more established companies. But here's the thing. Because the total stock market index fund is so broadly diversified, the impact of any one individual company, even a small one, is significantly minimized. Plus, historically speaking, small-cap companies have the potential to outperform large-cap companies over the long term. So, by including them in your portfolio, you're giving yourself a chance to potentially boost your returns. Now I know what you're thinking, Gupta, this all sounds too good to be true. What's the catch? Well, the truth is, there's no real catch. Total stock market index funds are just as easy to invest in as any other index fund, and they typically have low expense ratios, meaning you're not paying a fortune in fees. So if you're looking for a simple, low-cost, and highly diversified way to invest in the entire US stock market, a total stock market index fund is definitely worth considering. It's like the ultimate lazy portfolio. Just set it and forget it, and let the power of compounding do its magic over time. Chapter 4. International Index Funds, Going Global to Diversify and Conquer. Alright, we've covered the US stock market, but what about the rest of the world? You know what they say? Don't put all your eggs in one basket, and that applies to investing too. That's where international index funds come in, your passport to global diversification and potentially even bigger returns. Think about it, the US economy is huge, but it's not the only game in town. There are tons of amazing companies all over the world that are innovating, growing, and generating massive profits. By investing in international index funds, you're tapping into those opportunities and diversifying your portfolio beyond US borders. Now, there are a bunch of different international index funds out there, each with its own flavor. You've got developed market funds that track companies in countries like Japan, Germany, and the United Kingdom. You've got emerging market funds that focus on companies in countries like China, India, and Brazil, and you've got global funds that include both developed and emerging markets. The beauty of international index funds is that they give you exposure to a whole new world of investment opportunities. You're not just limited to the companies listed on US stock exchanges. You're investing in companies from all corners of the globe. Now I know what you might be thinking. Gupta, isn't investing in international markets risky? And you know what? You're right to be cautious. International markets can be more volatile than US markets, and there are always political and economic risks to consider. But here's the thing, by diversifying your portfolio internationally, you're actually reducing your overall risk. How? Well, different countries and regions have different economic cycles. When one market is down, another might be up. By spreading your investments across different geographies, you're creating a more balanced portfolio that's less susceptible to swings in any one particular market. Plus, let's be real, the US dollar isn't always the strongest currency in the world. By investing internationally, you're also getting exposure to other currencies, which can help to hedge against fluctuations in the value of the dollar. So, if you're serious about building a truly diversified portfolio and maximizing your long-term returns, international index funds are a must-have. They're like adding spices to your investment portfolio. They add flavor, complexity, and a whole lot of potential. Also benefit if the underlying companies increase in value over time. So, there you have it. Index funds, the simple, effective, and accessible way to grow your wealth over the long term. Whether you're just starting out or you're a seasoned investor, there's an index fund out there that can help you achieve your financial goals. Index funds are one of the easiest and safest ways to grow your wealth over time. Whether you're saving for retirement or financial freedom, investing in broad market index funds can set you up for long-term success. Remember, the key to successful investing is to start early, stay consistent, and let the power of compounding work its magic. If you found this video helpful, hit the like button, subscribe, and turn on notifications for more investing tips. Let me know in the comments, which index fund are you investing in?